Hi there and welcome to Hardman Talks. I'm Larissa Adams from Hardman & Co. and I'm going to be talking to Brian Moretta, our very own Head of Tax Enhanced Research. Brian, hi there. It's good to be chatting to you today.
My pleasure, and it's great to finally make my debut on Hardman Talks.
Brilliant. Okay, so Brian, you released a tax-enhanced white paper investigating the effect of adding venture capital to equity or bond portfolios for retail investors, and essentially answering the question, how much venture capital should investors be including? So shall we just dive right in and talk about what your approach was in answering that question?
Sure. So what I did was effectively a standard asset allocation approach, and a lot of this hinges on venture capital being a diversifying asset class. So a lot of that comes back to characteristics of venture capital companies. So you can imagine a startup, what they're trying to do is find their first customer or develop their first product or something like that. Or if they're slightly later on, they'll be saying, okay, we found a few customers, we've got a process, we now want to scale that process up. And that's kind of fundamentally different from a lot of quoted companies. So what you find is that quoted companies are very dependent, for example, on the economic cycle. So when we're in a recession, the stock market goes down. When economy's doing well, the stock market goes up. Venture capital companies don't behave quite the same way. In fact, what we've seen over the last sort of, if you like, pandemic recession was a lot of startups did really, really well, because there's a lot of digital companies, so they actually performed very, very well in that. So, but at the same time, when venture capital companies exit, usually they're selling to large companies, and they get better prices when large companies are flush with cash. So that means that venture capital companies tend to perform slightly differently, but not totally differently. So we did a little bit of research, or actually my research found other people's research, might be a better way of putting it. And we found that, the correlation between venture capital and quote equity is about half. So that suggests there's a good amount of diversification. It's not a complete diversifier. So for example, in this data set, bonds was about just under 0.4. So that suggests that bonds are even better diversified relative to equities than venture capital, which is kind of what you'd expect. So within that, we also need to figure out, so to do standard asset allocation, that's one of the key measures is the correlation. You need to figure out an expected return. There's been a lot of work on expected returns in venture capital or measuring historic returns. And there's various data sets, so various sort of angel-y startup things that seem to suggest returns in either low to high 20% IRRs. If you look at US research on venture capital, it's more like high teens, but I think the difference in America, obviously, you have bigger pools of capital, and the returns that are probably dominated by the large amount of money is going into Facebook or whatever. So we got all this data, found all this research, and kind of mix all up a process using something called modern portfolio theory, well-established asset allocation process.
Thanks, Brian. And what were your findings after you went through all this analysis?
Well, frankly, the findings were, for me, they were astounding, because you go into this with expectations, and one of the questions in the market was that people have sort of used this rule of thumb of sort of, okay, 10%, maybe the right, and the general seems to feeling, A, it's a round number, B, it's not too big, and it's kind of, it just sort of feels right, but does it feel right because we're used to it? So we all know venture capital is higher risk, but we also know it's high return. So fitting that in has been hard. And what we found is that actually the sort of asset allocations people would get, well, I think there's two steps. Firstly, adding venture capital can enhance returns. And I think that's the key thing. So by adding a diversifying asset, you can improve returns even for relatively low risk investors. Yeah. So even people who sort of, I compare it with sort of equity bond portfolio ratios. So so the core one I spoke about a lot in the report was 60-40. But even if you go down to people with 30% equities, adding a little bit of venture capital in the portfolio can improve returns without changing the portfolio risk, which I think is really key. So just because it's diversifying when you add something that's riskier, you still don't necessarily increase portfolio risk if you do it properly. But the asset allocation that we were getting was significantly higher than I expected. So 10% was kind of almost a floor for your standard risk investors. So if you think, most people are probably somewhere between a 60-40 and an 80-20 equity bond ratio at the moment. Yes, that would be your standard. I think 70-30 people have sort of spoke about as a sort of new default in a lower bond return environment or lower return environment. And we were getting sort of allocation to venture capital, low teens, mid teens, for high risk investors, maybe even high teens, which was significantly more than we expected. So yeah.
Okay. Yeah, well, you touched on it a little bit because, you were talking about maintaining risk. And I think it's important for investors to really understand the holistic asset allocation approach a little bit better, because when incorporating venture capital assets at different stages of the startup lifecycle, there's multiple ways to go about including that in the portfolio. And ultimately, investors are concerned about managing their risk when adding these new assets. So can you expand a little bit more on that?
Absolutely. So I think the mistake a lot of people think about when they look at this is they take the existing asset allocation and they kind of bolt on venture capital. So say if I'm a 60-40 investor, I'm going to put my 10% into venture capital, and then I'm just going to keep 60-40 balance on the rest. And that's clearly not going to work if you want to maintain a constant risk profile, because what you're doing is you're adding something riskier to the portfolio. So when I look at the figures, there's a rebalancing of the other assets. So what I call a holistic asset allocation approach. So when you're adding a venture capital, you don't just sort of add in venture capital, that's it done. You've actually got to look at the allocation of the other assets as well. So in the report, I talk about the 60-40 bond portfolio. And depending on which stage of venture capital you add in, you've really got to reduce the equity portfolio proportionally. So the ratios I got was sort of kind of 36-37% seemed to be, that was the proportion of equities you get, and increasing the bond proportion to over 50%. And when you think about it logically, that kind of makes sense, because if you want to keep a constant portfolio risk, but adding a risky asset, and even though it's diversifying, you've got to take risk out somewhere else. And equities are riskier relative to bonds. So if you want to, if you want to keep a portfolio risk, you've got to take more out of equities than you added in venture capital. So there's some interesting charts in the report, which I think give a good perspective on this.
Yeah, definitely. And you did quite a deep dive in the research note on the tax relief benefits and how this changes expected risk and return. And you did touch on this slightly before, but do you think you can share a little bit more detail on your findings there?
So far, I mean, today I've spoken very much about venture capital, but this is very much in the context of EIS and VCT, so Enterprise Investment Scheme, venture capital trusts, which are, most listeners probably know, most viewers, but these are schemes that the government has sort of said venture capital's risky, but it's also important to the economy as a whole. We want lots of new companies to start up, so therefore we're going to give a tax break to the people who invest in these companies, and these are really substantial tax breaks. So if you look at, there's a paper a few years ago, I think, from the EU, and of all the tax breaks for startups in the world, the UK has 4 of the top 5. It's like, these are really generous. So the main reliefs are, you get income tax relief, you get loss relief, which is an extra relief if things fail, that's under EIS. You get income tax relief on your dividends. There's no capital for venture capital trusts. There's no capital gains tax payable on exit. So these are really substantial benefits. But they're all expressed in terms of multiple of invested capital, or return on invested capital sort of things, which are great, but they don't take a time perspective. So I tried to figure out what's the effect on your, or the expected effect on your internal rate of return, which is kind of the standard measure that I think, and most people think, is more meaningful. And again, I mean, in a way, it told us what we knew, which is that when you add tax release in, they significantly enhance returns. So you look in EIS, so it's easier to look at these for EIS and VCTs, sorry, EIS and SEIS, because VCTs, because you've got the portfolio effects, it's all a bit complicated. But for EIS, you can add about 6 or 7 percentage points to your expected IRR just from the initial tax relief. And then when you have loss relief, you've got another few percentage points. If you use capital gains tax releases, that adds even more. SEIS, the seed enterprise investment schemes, even more generous. So that their upfront tax break is 50%. All right, there's a little delay, you get that, but by the time you take account of that and your loss relief on SEIS, you can pretty much double your IRR. So bear in mind, we're already talking about things in 20%.
Yeah.
that's really, so these are really generous returns or release.
Yeah. Okay.
So I should follow on. Of course, these have an effect on the asset allocation. So of course, these increase your expected return. They don't really, if anything, they actually decrease the risk. My analysis suggests not by a huge amount. It's funny, because the whole idea of these is to is in theory to reduce risk, and in capital terms they do, but in IRR terms they don't do that much, at least on a portfolio perspective. But obviously, if you throw in even more generous expected returns, you get even higher asset allocations in your asset allocation process. So suddenly we're getting things like, things that were sort of low teens suddenly become high teens, and things that were in mid to high teens become into 20%. I think we've got to be cautious using this, because a lot of people sort of saying, I put this into EIS or VCTs, or I put this into pensions, which also has a tax relief. So they're not quite the same, but if you look at those cancelling out, you're kind of more back in the sort of original scenario we had. I think I more sort of say, well, actually, it kind of underpins the original analysis and says, okay, the original analysis we've got is conservative. The industry is actually behind that original analysis. So let's just sort of focus on that. And if you want to be a bit more aggressive, you can justify it very easily.
Brilliant. Okay. So the last one, sort of on the actual note itself, if you had to pick out any key graphs or tables from the notes that you think are really telling, which ones would they be and why?
So I think there's 3 that really pick up on the points that I've already highlighted. So there's one that covers what's called the efficient frontier. And basically that is a map of risk and expected returns. So expected returns and risk. So usually there's a trade-off a little bit, but generally speaking, the better return, usually the higher risk you have to take to get it. And that creates something called the efficient frontier. And what I show is that you add in venture capital, that efficient frontier moves up, and it moves up quite significantly. So for normal asset allocations, you can add 0.5% to 1% a year on your expected return, which, given you're starting off at 5%, that's actually quite substantial. And we're talking over long time scales, so maybe 20 years. That really adds significantly to people's expected sort of lump sums at the end. So that's the first graph. The second graph, I think, is the asset allocations. So showing the sort of suggested asset allocation to venture capital, and again showing that these are higher. Now, in practice in the paper, I actually split things into 2. I used I just use these sort of categories of what I called seed and scale up. And seed are like the really earliest stage companies, the startups. Not necessarily getting CDIS, because a lot of EIS investments, but sort of smaller scale things, people finding minimum viable products, people finding product market fit. That's the sort of companies. And then you get scale up, which is generally things that are post product market fit and are trying to sort of scale up. And because they're better developed, you'd expect them to have a lower return. And it's all it is saying is basically venture capital is not homogeneous. So the same way the stock market's not homogeneous, you've got large caps, you've got small caps. People know that. Scale-ups are kind of like the large caps, if you like, of the venture capital world. So we kind of split this into those two categories. So we've got two asset allocation lines, one for each. Now, I suspect most people are actually going to take a blended approach because they'll have some seed capital and they'll have some later stage in their portfolio because you want, again, diversification, you want a nice spread. So that's the second chart. And the third chart is talking about this holistic asset allocation. And this chart shows, so you've got your 60-40 portfolio. What happens if you add seed? What happens if you add scale of venture capital? What's the effect? How do you actually have to adjust your bond and your equity weightings accordingly? And we've done it for 60-40 investor because that's kind of the old base. You can easily figure out what similar things are for maybe you 70-30 or 80-20 investor.
Excellent. Those are great graphs to sort of pinpoint from the research note. So moving slightly away from the research note itself, let's talk about why you wrote it in the first place. There's obviously lots of gray area with advisors when it comes to understanding venture capital and finding a place for it in their clients' portfolios. So would you say that this was a concern or a problem area in the market that you were trying to address with the notes?
I think the market, the SES and ES industry has a big problem in the market. It's a really big problem. And partly it's a function of its history, but you have these really attractive tax breaks, which are really easy to articulate. And what a lot of people in the market end talk about is, oh, there's all these tax breaks and you market these tax breaks. Oh yeah, and there's investment. But look at tax breaks and you don't need to, yes, it's a bit risky, but here's these tax breaks. And that's kind of the way a lot of the marketing industry works. And there were products 6, 7, 8 years ago that was appropriate for, because they were kind of, okay, we're playing the game, we're trying to reduce risk. They're not really proper venture capital. And consequently, the industry is kind of marketing itself on this taxing, or not the industry at all, but a lot of it is. There's a lot of people want to market investment, but they don't have a framework to say, here's the investment case. And this paper gives that case. It says, okay, you want to say, here's the investment reasons to recommend this. Here's the investment case. Here we show that, we ignore the tax release. I mean, we spend the first half of the paper doing everything without tax release, and we still say you should have more venture capital than this 10% that people are talking about. So there's the investment case. Now, a lot of advisors don't like this, and they say, oh yeah, well, what about the risk? Well, actually, we've shown you can do it without increasing risk. That's one of the points. You can, it's like this miracle. Diversification is this minor miracle. And then you get these other sort of things about, but basically invest. I think the problem is that it's seen as like something for high risk investors. We show it's something for everybody, but because it's seen as high risk investors, most advisors don't deal with it very often. And because they don't deal with it often, they try and avoid it because it is a bit of work to get into it. But what we're saying, it should be a normal part of most investors' portfolios, not a big portion necessarily, but it should be part of the portfolios. And it should be normalized. It should be there all the time, or almost all the time. There's still some very, if you're like 90% bonds, you were still saying, yeah, don't bother with venture capital. So, but how many investors are like that there? There's not very many, really, let's face it. So really, my ambition, I want to change this industry, which is kind of sounds a bit silly when I say it, but I think we can. I mean, here we've got this framework now to say, okay, we make the investment case. Forget about tax breaks. Here's the investment case, and and we're moving from a situation where advisors are not finding an excuse to get venture capital in, but they need an excuse to put venture capital out. You know, there are some exceptions, but they're a lot less frequent than most people think. So this should be normalized. And I think that's what my kind of ambition for this. I mean, it's not going to do it by itself, but I think it's a key part of getting us along that way.
It's the start of a very good framework that advisors can use. Absolutely. Perfect. So now the white paper was sponsored by 4 venture capital brands and has received quite a bit of attention already from advisors. So I think it would be helpful for investors to understand what the feedback has been like from the markets and possibly what their view has been on the research.
The feedback we've had so far is unsurprisingly positive. Certainly, you know, I mean, the sponsors obviously got, you know, sort of advantage side of that, and we really need to thank Deep Bridge and Syndicate Room and Nova and 149 for sponsoring it and enabling us to sort of get this out there, and also doing a lot and helping us in publicizing this, because it's interesting. One of them originally saw this work and they said, oh yeah, we'll sponsor that, and we actually agreed we wanted to get it to more people. So rather than doing it as a sole sponsor thing, we wanted to get this to a wider audience. And I think that the people who sponsored it come from really the same perspective as we do, where there's an investment case to be made. Let's make that investment case, you know, and we can put the tax not in the bin, because as the paper shows, the tax benefits are still fantastic. But if you take something that's really sort of got the investment case and then overlay the tax on top, that should be really, really compelling. And I think people are maybe starting to appreciate that. So as I say, I think it's going to be it's not going to be a quick process in changing people's perspectives and changing people's minds. There's still going to be people who are closed minded to this. There's people who don't understand that, okay, well, you shuffle around the other assets, or in some cases, it's just hard work to get into it, and they just rather not. But at the same time, I think people are sort of saying, well, here's a perspective that we can understand and makes the case. And it's nice to see people getting it, I think. So in terms of, you know, all the things I've just been speaking about, people are sort of understanding these points and they're agreeing with them and saying, okay, well, actually now now this gives us a framework to take in. And in some cases, there's been a couple of discussions. I was involved in one online discussion, and people sort of raising some of their objections, and I could answer their, you know, the objections about, you know, so you need, like, you know, so someone was saying, oh yeah, well, people have invested and lost money. Well, actually, you need proper diversified portfolio, because yes, some of these investments are going to be bad, but if you diversify well enough, you do that. And you know, maybe that's the next white paper, talking about that properly. Who knows?
Preview. Okay. Well, thanks, Brian. I think that is actually all we've got time for today, and it's all been really interesting. So thank you for spending the time with me.
My pleasure.
And to our viewers, please don't forget to like and subscribe to our channel. We appreciate your time. We will post the link to the white paper in the description below. Please do share your comments and hit that like button. Otherwise, we'll see you back here on Hardman Talks next time. Thanks so much.